All right, well, meanwhile, Wall Street appearing to shrug off Moody's downgrade of U.S. debt. The major indices closing around session highs. The Dow up 137 points. The S&P 500 now on a six-day winning streak. Even the Nasdaq down nearly 1.5% at its lows, ending in the green. Meanwhile, rates were largely higher, with the 30-year Treasury yield topping 5%, hitting its highest level since January, and mortgage rates topping 7% at their highs. Let's get insight on the big moves from Julian Emanuel, Evercore ISI Senior Managing Director. Julian, great to see you.
Great to be here.
We were just talking about Jamie Dimon's forecast for the markets. Are you on the same page here, or you think there's more upside?
No, we are on the same page. Mm-hmm. Look, you've come, and I will say this is equal opportunity hatred. There were a lot of people that week in April of the low were saying, why are you backing up the truck here?
Right.
A lot of the same people are saying, why aren't you a little bit more optimistic right now? Our view is the truth lies somewhere in the middle. And with the knowledge that valuation alone doesn't end a bull run, and ultimately we don't think it'll end this bull run, we just think it's a time to pause, catch your breath, and realize that you've swung so far the other way to this optimism where recession is, all but priced out, and it's not our base case, of course, but also that the tariff news is probably going to get maybe incrementally more difficult before it gets better.
Let's talk about the bond market then, because at one point today, I think 10-year yields were 4.55 or just short of it. Something happened midday where yields backed up, but I think yields are still a problem. What are you thinking here?
No question. But if you look at today, the trading pattern of the day didn't surprise us at all. Because, frankly, coming into the morning, there was this end of America exceptionalism, Act Two. We still think that the stocks that are connected to the AI theme are long-term outperformers. That outperformance resumed at the lows on April 7th. It's got longer to go. But the fact is that yields came in simply because we realized that getting the bill through the committee last night reduces the risk of default. Hello, that's good for fixed income, even if the longer-term view is that deficits are going to expand.
Julian, Moody's was later to this downgrade than they were to subprime. I mean, it was pretty obvious. All the things that they said didn't shock anybody. Curious, you think who the incremental buyers were today of 10-year. We know Scott Bessent's obsessed, obviously, with 10-year yields. We know that there's been some buying within Washington. I'm just curious to get your thoughts on the patterns you've seen.
So I will tell you again, when you think about how quickly and the week of the low in April, 81% of Evercore's clients thought we were either started a recession or one was going to begin in the second half of 2025. And you've gone the completely other way around. A lot of these are asset allocation trades. We've had a bunch of these conversations over the last week or so, and we know that however this is going to sort itself out, A, it does seem that the big, beautiful bill is going to ultimately make its way through. And B, look, Treasury Secretary Bessent has shown that he's very sensitive to the 10-year yield, and they're going to continue to fight to keep it down.
So what is going to stop the 10-year yield from reacting to fundamentals? I mean, there's nothing about the big, beautiful bill and what's going on with, I think, tariff policy, which is, I think, hurting the income side of the revenue side of the income statement. I mean, there's nothing in here that supports the fundamentals around the credit profile of the United States of America on top of issuance, that all we seem to do is talk about the refunding calendar in a way we never did before. So I don't think it's lights out for USA Inc. But I do think if he is obsessed, I think that's fair. I think that's important, by the way. That was part of kind of the shock that I think was going around Wall Street community, right? I mean, it's just kind of like this guy's one of us, and he doesn't seem to be paying attention to the important stuff here. At some point, you have to change the policy, or you really have to cut spending.
No, you do. And look, if you go back to the beginning of this bull market in October of 2022, we broke it down. The vast majority, above 90% of the gains, are attributable to when the 10-year yield was below 4.5%. Tiny gains between 4.5 and 4 3/4, above 4 3/4. Forget it. The market is actually returns negative. So to that point, look, the fundamentals are going to be very, very difficult. And frankly, Germany going to deficit spending to finance, the ongoing rearmament is secularly going to put upward pressure on yields. It's just that when we think about the economy, you aren't likely to get the sort of gangbusters growth that'll really send you through 5% on the 10-year yield.